Hey traders, this is Blake Morrow with Trader Summit, and with me today, because it's Friday, I have Mr. Jim Welsh from Macro Tides to draw. He's gonna break down this jobs report that we got today. Jim, what a number!
Yeah. It was a solid number. Expectations were for 180,000, came in at 272. So that was the surprise. A positive surprise. Markets reacted to that headline more than they reacted, if you will, to some of the details. And to me, the devil is always in the details.
How come I have this feeling that we're going to be digging into some of those details here in a moment? But
Well, I tried to hide the shovel out of the frame here, but you know me.
Yeah, I know you, Jim. All right. Well, one of the things that you'd been mentioning, and I know we're going to go through the charts
Yeah,
that you have. You've been talking about the S&P rallying to a new high before we see some sort of failure. So I'm
yeah,
assuming you're going to give us a little bit of an update on that. But
yeah,
overall, stocks are acting pretty well. The dollar came down quite aggressively. I think people, myself included, were really positioned looking for some dollar weakness and
yeah.
maybe a weaker jobs report. So the dollar obviously had an opposite reaction today, which caught not only myself but probably some other traders
Yeah.
on their back heels, back. Anyway,
And
um,
treasury yields popped pretty
yes,
aggressively on the
yeah.
number. So all the markets responded to the headline 272, and that's understandable. Again, I think the devil is in the detail, and there's some devil. There was a devil in this jobs report. Let me just put it that way, and we're going to go into it.
Well, we
So,
might as well get into it, Jim.
good God.
Let's jump right into your first chart here, and this doesn't have to do with the jobs numbers.
Now, the second chart is going to be the jobs.
Okay.
I put a bunch of the economic charts I usually put together on Thursday afternoon,
Yeah.
just because it takes a chunk of time.
Right.
And, we're trying to look at sometimes bigger factors or bigger picture and then bring it down to, okay, what does it mean to the markets right now today? And so this is private sector or credit growth. So what we can see, this goes back to 1960, when the annual increase or the percent of GDP, pardon me, when the annual increase drops below 6%. And you can see, hey, what's followed is a recession or at least a meaningful, really big slowdown. Some of the recessions were shallow, some far deeper, but we're obviously below that minus 6%. And I think about this as we live in a credit slash debt driven economy. Everyone feeds off borrowing money and consumption, or building new plants and equipment and getting, all right. So think of this as oxygen. So, in order to sustain the economy, you need a certain amount of oxygen getting pumped in. And what this chart to me suggests is we're seeing the oxygen level declining. And this affects more small businesses than large companies, because large companies can go to the credit market and issue bonds and raise a lot of debt that way. Small businesses don't have that option. So again, from a bigger picture standpoint, I believe that more and more data points are aligning with the economy is going to slow more than people expect. I think between now and year end, and the probability of a recession in 2025, I think continues to ramp higher. This is a chart that supports that bigger picture outlook.
All right. Well, thanks for bringing this one. Now, the next chart has to do with the jobs data, right?
Yeah. So, the point, you and I talked briefly before we started this, and, the establishment survey up 272,000. The household survey was down 408,000. Now, one shouldn't overemphasize any single month in the household survey. Those numbers are pretty volatile. And that's why you kind of have to look at them over 6 to 12 months. And when you start to do that, and this chart shows a 12-month average of both full-time minus part-time. So when you see full-time jobs starting to contract, which they did last month and have been relative to the increase in part-time jobs, that's the blue line. So this chart was through the April employment report, including the data from this month's report. That blue line is going to be dropping more, all right? And this has a pretty good history of leading full-time job, the establishment survey, instead of showing 272,000, all of a sudden, it's going to show something far less. And we've talked about this. I've written about this extensively in the last handful of months, because at inflection points, the numbers kind of get messed up. But you have to understand that that's what's taking place. So as you come out of a recession, the household survey does better. And because you get more full-time jobs than part-time jobs. When the economy starts to weaken, you start to get more part-time jobs than full-time jobs. It's just the nature of the way the labor market works. And so, again, this is another indicator that, to me, okay, wow, 272,000. Oh, wow, it's wonderful, really strong. To me, this is an indicator that kind of says, all right, let's look at the bigger picture here and the dynamics between full-time and part-time jobs. And it's not good.
Okay.
The other thing I'll mention, the unemployment rate ticked up from 3.9 to 4%. No big deal, all right? However, historically, going back, I think, to 1945, whenever the unemployment rate has ticked higher by 0.6%, which it has, from 3.4 to 4%, a recession has followed. So again, we're seeing other data points. Now, the unemployment rate is derived from the household survey. So again, looking at the household survey for 1 month is a mistake. Looking at it over an extended period of many months, we've seen the unemployment rate slowly but surely increase from 3.4 to 4%. The bank credit analyst, I may have shown this a few weeks ago, looks at employment in states and then weights it based on population and so forth. Their model in March gave a recession signal. And normally within 6 months, you start to see labor market weaken. So, I'm not trying to be Debbie Downer here. I'm just trying to add a little level of objectivity and insight beyond the headline of, gee, 272,000 jobs. Because most people, Blake, that's their research. I saw a headline that said 272,000, so I don't have to worry about the economy.
Yeah.
And I think that that's a mistake. It's always important to look under the surface, gather as much detail as you can. One of two things happen. Hey, it agrees with the headline. Terrific. If it doesn't, then it alters one's view, and the majority of people just look at the headline.
That makes sense. I mean, it's easy to look at the headline. It's more difficult to dive into the details and find those devils, which you do for us, Jim. And that's why people love to listen to you on this video every week. So we appreciate it.
Now somebody's going to suggest that I wear some kind of a hat that has a couple devil, Okay.
All right. So
all right, onward.
The next chart you brought is about rate cuts. Now, obviously things got repriced, or we're repricing the repricing.
Yes, we are. So I went back the last I guess 50 years and looked at rate cuts and what happened. So there's perception right now on Wall Street, they're begging for rate cuts, almost. Can't wait till we get rate cuts. And the Fed said, well, we're not getting rate cuts until inflation falls down, or they don't talk about this aspect, the economy weakens more than we expect. And historically, what you can see is when they cut rates and the economy ultimately then goes into a recession, the S&P falls a lot after the recession begins. So historically, the S&P has, of the bear market declines, is like 38%. 84% of the decline happens after the first rate cut. Now, the red lines where I say excluding 1998, the reason why I have that in there, no recession happened, and it was an event that the Fed responded to. Long-term capital management was using 100-to-1 leverage, 3 Nobel Prize winners, and they blew up. And so there was a systemic risk, or the perception by the Fed that there could be systemic risk. So they cut the funds rate in a sense just to, okay, an insurance cut. And the numbers get worse if you exclude that. It's 88% of the decline instead of 84. The bear market declines are at 40% instead of 38. But my only point is the issue of recession is a really big deal. If somehow we do the soft landing, there still could be a sell-off in the market. Here's underneath the bottom three are 1987, 2011, and 2018. Pretty meaningful declines. And I think, again, if the economy slows enough to raise concerns that it might be going into a recession, I think the S&P is going to decline. Is it 10 to 15%? Probably. As long as you don't go into a recession. But this, to me, quantifies the stakes of this whole debate. We got 272,000 jobs. We don't have to worry about recession. The devil's in the details kind of say, this isn't such a good number or as good as it looks like. And forward-looking indicators of the labor market suggest we're going to see the unemployment rate go higher. So far, we're seeing it. It's creeping. And historically, again, the labor market, the unemployment rate is a lagging indicator. Businesses don't want to let people go, especially after the last 2 years where it took so much effort to get good people. So it's always a lagging indicator. And it only happens when their hand is being forced. Sales are softened enough. I got to figure out ways to cut costs. And for a lot of businesses, labor is 60, 70% of their costs. So.
Yeah, interesting. Okay. Well, the next chart you brought, I'm sensing it has to do something with NVIDIA.
Kind of.
Okay.
So the left-hand side, concentration risk. So this is looking at the top 10 weighted stocks at any given time in the S&P and what percent did they represent of the S&P. And in 2000, it was, I think, 27%. And now we're pushing 35%. Is NVIDIA part of this game? Absolutely. But what's happening here on the right-hand side, look at the disparity between the S&P and then the momentum aspect of the S&P. It's up 30% more than the S&P. So this is, again, concentration in a small number of stocks leads to concentrated buying in those stocks relative to all the other stocks, the other 490. And that momentum has shown this kind of disparity. And if you're a money manager trying to compete with the S&P, man, you're kind of like, I want to keep my job. I better buy these stocks that have high momentum. And in the short term, it plays off. But momentum is a two-edged sword. As anybody who's invested in markets knows, there's the happy side if you're on the right side of the momentum, and then there's the not so happy side when it goes against you.
Sure.
And so, all this is just showing the folks we're building a structure, in a sense, the pyramid, instead of the base of the pyramid being wider, slowly but surely, we're turning the pyramid upside down so that the point is what's holding the whole rest of the pyramid. Historically, that has not led to good times. It might take a year or two to manifest, but ultimately it will.
So is GameStop included in this top 10 weighted?
No.
I'm joking. All right.
You're gaming the gamers.
All right. So here is the next chart
Yeah.
you brought, Jim, is this is another equal weighted relative.
Yeah.
Okay.
I mean, what I'm trying to do here is to kind of show what's happening underneath the surface. You look at the S&P, new all-time high, hip, hip, hooray. So the equal weight S&P gives all 500 stocks a 0.2 weighting. Well, the top 5 stocks, I think, are at like 30-some% now. All right. So this shows that the equal weight S&P since July of last year is down over 10%, right? But look at since April, it's gone, it's dropped another, of that 10% plus is 5.7 of it is just since April. So there's been a decided weakening. Well, what's happened since, April? We know. Then in terms of since June of last year, the S&P's up 25%. This is as of a couple of days ago. Mid caps are up 14.9, and the small cap 600, which is a variation off the Russell 2000, only includes 600 stocks. It's a little better quality of an index, is up a lot less. So again, what you can see is off the October low of last year, the red and purple lines representing the small and the mid cap pretty much kept pace. In fact, they narrowed the gap a little bit. The gap was wider at October of last year, narrowed it. And then the mid cap kept pushing with the S&P up into the March high. And now it's really struggling. And the Russell really peaked in December. And everybody keeps talking about how the market's broadened out. That was a true statement a few months ago. It's becoming less and less of a true statement now. And yet everybody's, well, the market's been broadening out. Okay. For the first time, I didn't include this because we got so many charts today, the advanced decline line. In March, as the S&P made a high at 52.65, okay, we're going to get a 5 to 7% correction. And the reason it's only going to be 5 to 7 is because the AD line made a new high in March. Guess what? This week, the AD line has not made a new high. Now, it's not that far away, and so it might still make it. But all this other information to me is like, all right, we're setting up for another 5 to 7% pullback. And I think the next chart, Blake just disappeared. There
Oh, no, I'm here. I'm still here, Jim.
I know. I just figured,
Yeah.
You had to, grab a shot. I mean, a shot glass. No. Okay. So again, negative divergences. When the market's healthy, the major market averages trend up, or even a healthy decline is when they're all trending down together, making lower lows, right?
Yeah.
Well, look at what's happened again since March. The S&P, hey, we're making new highs. You look at the New York comp. Oh, it made a new high in March too, just like the S&P did. Then you look at the value line, which is an unweighted index of 1,700 stocks. The New York comp is around 1,700 stocks. So it's a much broader umbrella, if you will. Well, it didn't make a new high in March. And look at where it is now relative to where it was in March. It's quite a bit lower. Now, we can go through the transports. We could look at the Dow. The majority of market averages, other than the S&P, the semiconductor, and the Qs, they're all making new highs, but they're part of the concentration issue. And so historically, Blake, important tops have formed when you get these kind of divergences showing up. So all this stuff to me implies a 5 to 7% correction, I think, is soon. And then I think the next chart is looking at the pattern of the S&P. When we talked last week, it was like, okay, I think we're going to a new high. And it's unfolded. Now, if we go back to the low in April, you can kind of see 1, 2, 3. It was the high in March. We had wave 4 at 51.91. And now what we can kind of look at is that, wait a second, for wave 5, we got 1, 2, 3, 4. And today, this morning, first thing we made, a higher high. So technically it could be done. At the same time, I could see the S&P pushing to 5,400, in part because wave 1 was of wave 5 was 111 points. From 51.91 to 53.02, you had 111 to 53.31. Okay, you could actually make a case for 5,400. I would be surprised if it got that far. My whole point in this, elongated presentation about the market is I think we're setting up for a high, and at a minimum, a 5 to 7% correction is coming. Some of the momentum indicators, like looking at the 5-day expo versus the green 13. This is a 2-hour chart. So you can see nice gap there still. So, things obviously have not rolled over, but I think it's just what I'm trying to do is say, folks, we're at an inflection point in the market. Even if it goes up another 1% from where it is right now. The bigger move, I think, is, at least to drop back down to 49.54, and potentially it could be bigger than that. So we'll see.
So the risk reward would really favor if we hit a fresh high to look to be on the short side or sell into that strength if you're long.
Well, yes. And if you're looking to go short, wait for things to roll over a little bit. Just, because, hey, we're in a little bit of a crazy part here. So things can always extend a little bit higher than I expect. But the weight of the evidence in what we've just covered, Blake, suggests there's more risk than reward at these price levels.
Got it. Okay. Well, let's talk a little bit about the dollar, because the dollar got, it strengthened pretty strong.
Nice boost.
It came really, really good today following the data.
Yeah. I mean, the last 2-3 weeks, my talk was, I think we're going to go below 104.08. It declined 2 points from the 106.52 to 104.52, and then 2 points from that high at 105.74, projected 103.74. It got to 103.99. All right. That pattern was then, okay, we're going to get below 104.08 and perfectly get down to 103.74, and then we're going to have a bounce. They got to 103.99, and the jobs report obviously gave it the potential for a bounce. The 618 retracement is up around 105.54, and that's of the decline from the 106.52 to the 103.99. Gets you to 105.54. So I think this bounce will probably go for a little bit more. Then I think we're going to see another leg down that takes the dollar below 103. And, right now everyone's living off the fumes of the jobs report, which probably lasts for a little bit.
Sure.
This data coupled with the ECB cutting rates, even though it was a hawkish cut, supposedly, I think it also added some octane to the dollar's move today.
Sure. But next week we got CPI, we got the FOMC. I mean, it's a big week next week.
It's a very big week.
Bank of Japan too.
Yeah, and the Fed is going to come out with new projections. Their dot plot, the summary of economic projections, are going to come out. Everyone's going to be looking and should be looking at, in the March, they had 4.6% on the funds rate, which still implied 3 rate cuts. That number is not going to be 4.6. Is it going to be up to 490, which would imply 2 cuts? All right. Or 5.1, which would imply 1 cut. And so obviously the jobs number is those who are at least talking about in their meeting, well, we might have to entertain the idea of a rate hike. Those people are going to say, well, listen, look at the jobs report. The CPI next week, Blake, is going to be interesting. The takeaway value from May of 2023 was 13 basis points, I believe, for the headline, but 36 basis points for the core. So I think what's going to set up next week is you could see the headline CPI tick up, but I think the core is going to tick down. So it'll kind of mute, if you will. Oh my God, the headline. Oh yeah, but look at the core. So that's going to be kind of a mixed thing next week. And then again, between the Fed, the SEP, and the CPI, that might provide the dollar some more legs to get up to that target of 105.54.
Got it. Okay. Well, let's take a look at gold, because gold got slapped today. And gold hasn't really acted too well. I know we've talked about that the last couple of weeks, but it just really hasn't acted so well.
Well, in this week's weekly technical review on Monday, what I suggested was that we could see gold rebound to 2073 to 2088. That was the 50 and the 61.8 retracement of the decline from 24.49 down to 23.27. So it got there. My take was that would be wave C of an ABC that will be followed by a decline of $122. because that's how much gold went from 24.27 down to the 22, whatever that number is. I can't read it.
2281.
Oh, that one. Yeah. So the idea, the bigger picture, and we talked about this last week. My expectation is, and has been, we're going to see gold take out the 2281. That will be wave 4. So going back to last year, wave 1 up from 1812 to 2122, pull back to 1986, wave 3 ended at 2427, and then you had an A down, B up to a higher high at 2449. Then you had a key reversal, or a reversal, I should say. It wasn't a key reversal. And what we've talked the last 2 weeks is, hey, when these reversals happened before, on December 4th, April 12th, it led into a longer pullback, both in terms of time and price, which is why I was favoring the likelihood of a 2281, a drop below that. I still think that and obviously today's move reinforces that pattern. And for me, if indeed it gets below 2281, it could get down closer to 2240. But I think that's a buy, because after that, I think we're going to see gold ramp to a higher high towards 2,500 or so.
Okay, well, I know there's a lot of gold bugs listening in that can't wait for that to happen. The last chart you brought, Jim, is TLT. We've seen obviously a big reversal today due to the jobs data. So do you buy this dip in TLT, or what are you doing?
I would. Again, the bigger picture is from the low of last year at 82.42. TLT rallied to 100.57. I thought that was wave A. We were going to have a B wave pullback as people realized the Fed wasn't cutting 6 times in 2024. I believe that bottomed in late April at 87.34. Got 5 waves up for what I think is wave 1 of C, the pullback to 88.66, wave 2. And so I think we're beginning the rally from 88.66 to 93.40 is wave 1 of 3. This pullback is wave 2 of 3. And I think TLT is going above the wave A high. All right. So to me, the stop on this is 88.66. That pattern starts to fall apart if you take out that level. So you can see I have the retracements of the rally from 88.66 to 93.43. Those are the retracements. And, so to me, again, I think people overreacted to the headline. And I believe the economy is going to show more softening, not acceleration. And ultimately, in the second half, I think of this year, things are going to slow a lot more. If I'm wrong, hey, 88.66 is going to get taken out. So that has to be the stop, in my view.
Okay, well, it's hard when you see the markets coming down like this to start catching falling knives, if you will. Yeah, or a falling piano. I always say just let the piano hit the ground and we'll pick up the keys afterwards. But hey, you do you.
Yeah. Well, this is a case where let's say you look at a 1-hour chart and you use the 5 and 13 exponential moving averages on that 1-hour chart. Well, guess what? The 5 is below the 13. If there's a wave 3 of 3 coming here, guess what? The 5 wave is going to tick above the 13 as that begins to really take hold. So the CPI number is important next week. As you said, the Fed is very important. I think, the Fed is it's going to present a more hawkish tone, I think, on balance, not like, oh my God, huge. But I think there's going to be an objective presentation that the economy continues to be more resilient than we expected. And that just tells us that we need to hold the funds rate at the current level because we believe it's restrictive for even longer, and that eventually inflation is going to come down. So, that I think is going to be the message from the Fed. If the bond market takes that and says, oh my God, we're really in trouble, it'll take out that 88.66. And if it shrugs all that off, it's more, to me, confirmation that the tide has turned from that low in April and the trend is higher.
Yeah. So it's going to be an interesting one to see how the bond market responds to that type of messaging, and the dollar too, for that matter.
Yeah. Yeah, all the markets, obviously, but that again, why I think technical analysis is imperative when you get to these places, because it at least says, all right, this is where I'm wrong. And ultimately, when we trade markets, knowing when you're wrong is probably more important in more cases than, oh, look at the market, it tells me I'm right. That's great.
Right.
So, that's why the blend of technical and fundamental, I think, is it's been really helpful for me.
And I think it's been helpful for a lot of people. And so if it has, folks, make sure you give Jim a big thumbs up, subscribe to this channel, and to get more information from Jim, visit Macro Tides. But how do people get your most current technical review?
Jim Welsh Macro at Gmail. And I just sent out the June Macro Tides, and I do a weekly technical review every Monday. So happy to send that out, because I think we cover a lot of stuff in detail, but I go into greater detail, obviously, in the monthly letter and present more information.
Yeah.
Which for me increases my conviction about what I think the markets are going to do. And then looking at the technicals, it's like, okay, I'm not completely nuts here. There's a case to be made on the technical side to support that view. So.
And I'll be the first one to say that your not only your technical review, but your editions of Macro Tide does have a lot of charts and a lot of information in there. And you really break it down for individuals. So I want to thank you for that, and I want to thank you for spending your time here with us every Friday. And if you guys and gals enjoy it, make sure you give Jim thumbs up, jump in the comments down below, and if you want to add anything to this discussion. Jim, thank you so much.
Well, thank you to the people who listen. This was a little longer than normal, but there's a reason why. So thank you. Have a great weekend.
Good luck next week, Jim, and we'll talk to you next week.
You got it.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.